As of 9:50 a.m. Eastern Time, November 17, 2025, Beyond Meat, trading under the ticker BYND, is at $1.09 per share, up about 1 cent or just under 1% on the day. It opened higher at $1.12, hit $1.13, but has since slid back down to the low of $1.07 and is now trying to hold this $1.09 level. Volume is already heavy, with nearly 9.7 million shares traded in the first 20 minutes of the session. And let's just pause and absorb that price, $1.09. A company that was once the absolute darling of Wall Street, a stock that traded at nearly $240 a share, is now trading for less than the price of a single pack of its own product in most grocery stores. The expectation for Beyond Meat was that it was a technology company, a high-growth disruptor that was going to fundamentally reshape a trillion-dollar global industry. It was supposed to be the Tesla stock of food. The reality, staring us in the face at $1.09, is that it is a food manufacturer with brutal to non-existent margins, collapsing demand, and a balance sheet that is flashing code red warnings. The expectation was a new asset class. The reality is a penny stock, and it's hanging on by a thread. This isn't an investment anymore for most. It's a speculation on survival itself. The entire market narrative for BYND collapsed just last week. The catalyst for this current painful price level was the company's third quarter 2025 earnings report released on November 10th. It wasn't just bad, it was a portrait of a company in a complete nosedive. Net revenues came in at $70.2 million. That sounds like a lot, but it was a 13.3% decline from the same period last year. A company that is supposed to be in its high-growth phase is aggressively shrinking. But that wasn't the headline. The headline was the net loss. On $70.2 million of revenue, Beyond Meat posted a net loss of $110.7 million. This is, to put it mildly, catastrophic. They lost significantly more than they brought in. How is that possible? A huge piece of that loss was a $77.4 million non-cash impairment charge. In plain English, the company had to officially admit that its assets, its factories, its equipment are not worth what the company was claiming they were worth. It's an admission that their long-term performance expectations have been diminished. And if you thought that was bad, their guidance for the future was even worse. Management guided for fourth quarter revenue to be between $60 million and $65 million. Wall Street was expecting over $70 million. The shrinkage is not only continuing, it's accelerating. This is why you saw analysts at Mizuho and Barclays come out and slash their price targets to $1. When analysts who used to have $50, $80, $100 targets on a stock are now issuing $1 targets, they are not telling you to buy. They're telling you this is likely heading to zero. The consensus rating on the stock is now a sell, with a significant portion of analysts branding it a strong sell. This is the kind of report that makes you log into your Fidelity or SoFi Invest account, look at your portfolio, and thank your lucky stars if this wasn't one of your core holdings. This is the danger of self-investing without a deep understanding of financial statements. The story was great, but the numbers are a disaster. So what is happening on the trading floor today? That 9.7 million shares in volume isn't hopeful buying. This is capitulation. This is institutional holders and retail investors who've been holding on for years, who bought on the Robinhood app during the hype, finally giving up and dumping their shares for whatever they can get. The 52-week range for this stock is 50 cents to $7.69. We are trading right at the bottom of a range that is already catastrophic. Let's look at the institutional filings. The 13Fs show a very interesting picture. Yes, the big passive funds like Vanguard and BlackRock are there, as they have to be for their index funds. But the active money is all hedge funds. We see names like James Street, Citadel Advisors, Point72, and D.E. Shaw. And their filings show massive put and call positions. This isn't a long-term investment for them. This is a trading vehicle. They are using sophisticated platforms, the kind you see with interactive brokers, to trade the volatility, betting on these wild swings. They are not investing in the company's future. They are arbitraging its demise. Let's step back and ask the big question. How did the expectation get so disconnected from this reality? Beyond Meat was founded on a simple premise: use plant-based inputs like pea protein to create a burger that looked, cooked, and tasted like real beef. The goal was to appeal not just to vegans, but to flexitarians and meat eaters, tapping into a growing consciousness about health and environmental sustainability. When it went public in 2019, the market didn't value it as a food company like Tyson or Hormel. It valued it like a technology company, like NVIDIA stock or Apple stock, applying a valuation based on future potential, not current earnings, because there were no earnings. The belief was that this was a disruptive technology. The problem is that belief has shattered. There are three core problems. First, competition. When Beyond Meat started, it was a novelty. Now, the grocery aisle is packed. You have Impossible Foods, but more importantly, you have the giants, Conagra, Kellanova, and even meat producers like Tyson have their own plant-based lines. And crucially, you have the private label store brands, which are significantly cheaper. The moat that investors believed Beyond Meat had simply wasn't there. The market for plant-based alternatives is growing globally, but Beyond Meat's share of that market is collapsing. Second, the consumer. The company's core thesis was that consumers would be willing to pay a premium for its product. But in an inflationary environment, with consumers watching every penny, that thesis has been proven wrong. Consumers are trading down, and they are not just trading down to cheaper plant-based brands, they're trading down to cheaper animal protein. Demand for animal meat is at multi-decade highs. The consumer wasn't switching for good, they were experimenting. And for many, the experiment is over. The company's own earnings report admitted to sluggish overall demand and inflation pushing consumers towards less expensive food options. And this is the most critical point for its survival: the cash burn. The Q3 report showed a $42 million cash burn. They ended the quarter with $117 million in cash and short-term investments. If you are burning over $40 million per quarter, that $117 million isn't a war chest, it's a countdown timer. They have maybe 2 or 3 quarters left at this rate before they are completely out of options. This brings us to the CEO's comments. On the earnings call, Ethan Brown tried to spin a positive light, not on sales, but on the balance sheet. He highlighted that the company had restructured its debt, exchanging its 2027 convertible notes to extend its maturity. This is financial engineering, plain and simple. It's what companies do when they can't operationally fix their problems. They're trying to buy time, but buying time costs resources, and they are running out of both. They are suspending operations in China. They are cutting costs, but you cannot cut your way to growth. This isn't a growth story anymore. This is a survival story. Looking at this Q3 report, with a $110 million net loss on just $70 million of revenue, comment below, is this a case of mismanagement, or did the consumer market for this product simply never exist at scale? I am genuinely curious what your take is. So what happens from here? What is the future outlook? The expectation versus reality framework is now starker than ever. The old expectation of global changing growth is dead. The new expectation, for many, is bankruptcy. The bear case is simple. The cash burn continues, the sales decline accelerates, and the company is unable to raise more capital. Because who would lend to them? They run out of cash by mid-2026 and file for Chapter 11. The $1 price targets from Mizuho are pointing directly at this outcome. When you look at your Fidelity brokerage account, this is the risk you are underwriting at $1.09 per share. Is there any bull case left? It's thin. It is not a turnaround in the traditional sense. The only realistic positive scenario for shareholders is a buyout. At a market cap of just under $500 million, Beyond Meat is now small enough for one of the food giants, a Nestlé, a Tyson, a Unilever, to swoop in and buy them for pennies on the dollar. They would acquire the brand name, which still has some recognition, and scrap 90% of the corporate overhead. They would then plug the product into their own massive, efficient manufacturing and distribution systems, where it might actually be profitable as a tiny niche part of a larger portfolio. This is the only scenario where shareholders might see a small premium from this $1.09 price, but that is a gamble. It is not an investment thesis. It's hoping for a rescue. This entire saga is a painful lesson for the online investing community. It shows the immense danger of falling in